Welcome to Lesson 19 of our Financial Statements course. Today we wrap up our balance sheet discussion by exploring the final critical piece, shareholders' equity. Hello everyone, I'm Professor Matt with the Fundamental Investing Institute. In our previous lessons, we covered assets and liabilities. Today we're finishing the balance sheet by discussing the residual value that belongs to a company's owners. Remember, the balance sheet shows a company's resources and the claims against them. Equity represents the claim that remains after all obligations are met. It's the owner's slice of the pie. There are two key engines that drive shareholders' equity: paid-in capital and retained earnings. One represents what owners put into the business, and the other represents what the business generates and keeps for itself. When a company is formed or needs growth capital, it issues stock to its owners. The money they contribute in return is called paid-in capital. It's the literal investment base of the corporation. Common stock is the basic equity unit. The number of shares a company can issue is set in its articles of incorporation. Sometimes stock has a par value, a nominal accounting number, that separates capital into different categories on the books. The second major component is retained earnings. These are the profits the company keeps to reinvest in its future, rather than paying them out as dividends. Keeping these profits increases the owner's equity over time. Think of retained earnings as the company's savings account. Every dollar of profit that isn't sent to shareholders as a dividend adds directly to the value of the business, strengthening the balance sheet and fueling further growth. Occasionally, a company might buy back its own shares from the market. We call this Treasury stock. Because the company is essentially returning capital to owners, it actually reduces the total shareholders' equity on the balance sheet. One final crucial note: shareholders' equity is an accounting value. It tells you what's on the books, but it isn't necessarily what the stock is worth to investors. Market value can be much higher or lower than this book value. To recap, equity completes the balance sheet equation, representing the owner's residual claim. It grows through investment and profit, and it serves as the foundation for how we value a business on paper. That concludes our discussion of the balance sheet. In our next lesson, we'll dive into the cash flow statement to see how money moves through the business. I look forward to seeing you then.